In this video, we're going to talk about unearned revenue. And because this account can sometimes confuse people, I'm going to jump right into an example to explain what unearned revenue is. So let's say that you sell, you have a firm and you sell a 12-month magazine subscription to a customer. 12-month magazine subscription. I'll just put sub here, I'll just abbreviate. So you sell this, and let's say it's for $24, and you sell it on January 1st, just to make things easier. The sale takes place on January 1st. And so now let's think about what journal entry we're going to have here. So here's I'll just say JE, our journal entry. January 1. What happens? Now, let's say that this customer is paying $24 cash. Okay? Now, we can easily figure out what's going on then with the debit side of things, right? We're getting cash of $24. Now, what happens with the credit? What happens here? That's really what we're going to have with this unearned revenue account is going to come into play. And you might be saying, well, why don't we just credit sales? Why don't we just credit regular revenue? We sold something, right? We sold the subscription, and we got $24 here. So why aren't we just crediting sales? Well, the reason is that when we make the sale on January 1st, we haven't actually shipped the magazines. We haven't delivered the goods to the customer, right? This person who paid the $24 hasn't gotten any magazines yet. They just paid the money up front. So because we're receiving the cash, but we haven't actually delivered the goods or provided the services in question, we still have an obligation. We still have an obligation to our customer. Now, granted, we don't owe them money like we'd normally think of an obligation. We think of a liability, but it's a different type of liability. And what we call it is this unearned revenue account. That's how we categorize it. It's basically, it's a liability because we have to sacrifice assets in the future. We're going to, at the end of the month, for instance, when the first month of this 12-month subscription comes due, we're going to have to ship a magazine, right? And a magazine is an asset to us, right? That's part of our inventory. So we have an obligation to sacrifice some assets, and so we're going to have, it's actually going to be a liability. And let me just break out the eraser here. Well, it's not erasing. So we're going to have this unearned revenue account. Let me just write it below, and I'll just scribble this out. Apologize. So we're going to have a credit to a liability account called unearned revenue for $24 because we have not delivered those magazines yet. We have not earned this revenue, so therefore it's unearned, and it's a liability. It's going to show up on the balance sheet, right? This is a balance sheet account. This isn't going to go to the income statement and affect net income or anything like that. It's a liability because we have an obligation to sacrifice some assets. Now, as we perform our obligation, as we actually ship magazines to our customer, as we sacrifice those assets, now we can start gradually moving things out of the unearned revenue account and shifting them to revenue as that revenue is actually earned. So let's go and let's say that this 12 months, so after the end of the first month, so let's say it's January 31st. Let me just change colors here. So on January 31st, we're going to have another entry, right? We just shipped out this magazine, so now we need to decrease the unearned revenue account, and we need to recognize some of that unearned revenue as now being earned. But how much do we do? Well, we've got 24 was our amount here, and then we just divide that by 12, right? There's 12 months. There's a magazine every month. So that would give us $2 every month, right? So just taking 24 and dividing it by 12. So we're going to recognize $2 of revenue is now being earned, and so therefore we have to get $2 out of the unearned revenue account. Now remember, unearned revenue is a liability, so it decreases with a debit. So we're going to have unearned revenue will be 2, and then we'll have a credit now to revenue of $2. Revenue of 2. And we're basically, what we're doing here is we're reflecting the fact that now $2 of that 24 that we originally received has now been earned because it's the end of the month and we've shipped out one of the magazines, we've performed part of our obligation, and we can go ahead and shift $2 from that unearned revenue liability account. We go ahead and move that into revenue, where it's going to actually go to the income statement and end up affecting net